and August respectively, down from 6.3% in June. Food price inflation in August accelerated to a recent high of 11.6%, with the category of food and non-alcoholic beverages contributing 1.7 percentage points to the overall inflation outcome. Goods price inflation measured 6.1% in August, down from 6.5% in July, while services in price inflation was changed at 5.7%. The bank's measure of core inflation, which excludes food, fuel, and electricity, was also unchanged at 5.7%. Producer price inflation for final manufactured goods increased in June and July to 6.8% and 7.4% respectively, following a decline to 6.5% in May. This acceleration is due to the impact of the drought on manufactured food price inflation, which measured 12.6% in July. This was its highest level since January 2009. Producer price inflation for agricultural products also remained elevated at around 20%. The latest inflation forecast of the bank has improved over the first 4 quarters of the forecast horizon and remains more or less unchanged for the rest of the period. Inflation is expected to peak at 6.7% in the 4th quarter of this year, compared with 7.1% previously, with an earlier sustained return to within the target range now forecast to occur during the 2nd quarter of 2017. Inflation is expected to average 6.4% in 2016 and 5.8% in 2017, compared with 6.6% and 6% previously. The forecast for 2018 is unchanged at an average of 5.5%. The downward revisions are due in part to a lower starting point, lower administered price inflation assumptions, as well as less depreciated exchange rate assumption. Compared with the previous forecast, core inflation is expected to average 0.1 percentage point less at 5.7% and 5.6% in 2016 and 2017, and is unchanged at 5.3% in 2018. Core inflation is expected to remain within the target range over the forecast period, with a peak of 5.9% in the final quarter of this year. Inflation expectations are as reflected in the survey conducted by the Bureau for Economic Research, have remained relatively unchanged, but with some changes between the different groups of respondents. Average inflation expectations declined by 0.2% to 6% for 2017 and remained unchanged at 5.9% for 2018. While expectations of both analysts and business people declined, those of trade union officials remained unchanged for 2017 but increased for 2018. The long-term 5-year ahead inflation expectations are unchanged at 5.9% and remain uncomfortably close to the upper end of the target range. Inflation expectations of analysts, as reflected in the Reuters Econometer survey, have also shown successive declines during the past few months, with the median expectations for inflation to return to within the target range during the 2nd quarter of 2017. Long-term expectations of market participants implicit in the break-even inflation rate, the yield differential between conventional bonds and inflation-linked bonds, declined further since the previous meeting of the MPC although they remain above the upper end of the inflation target range. The global growth outlook remains subdued amid slowing growth in the advanced economies and a general downward revision to the forecast. Although prospects for the US economy remain relatively favorable, outcomes have not been consistently positive, as evidenced by the recent weak consumer expenditure and manufacturing sector data. Nevertheless, labor market conditions have improved and the investment slowdown appears to have bottomed. Although the short-term impact of Brexit on the UK economy have not been as negative as initially feared, growth forecasts have been revised down as concerns remain regarding the longer-term investment outlook. The euro area recovery remains steady but subdued. The Japanese economy remains caught in a deflation and low growth bind following a weak second quarter. The recent firmer trend in commodity prices has improved growth prospects for commodity-producing emerging markets in particular, along with more favorable capital inflows. It is unclear how long these positive developments will continue. Indications are that the negative growth cycles in both Russia and Brazil have turned, and both countries are expected to record positive but weak rates of growth in the near term. The Chinese economy appears to have stabilized following concerns about a slowdown earlier in the year, but concerns regarding the financial sector persist. Given the broadly benign global inflation environment, apart from some emerging markets, monetary policies have generally remained accommodative, with further loosening or loosening bias in a number of advanced economies. A notable exception is the United States, where the bias remains for a resumption of interest rate normalization, but the timing remains uncertain. Following the decision of the Fed to keep rates unchanged yesterday, the market expectation is for the next move to be in December. The data-dependent nature of future decisions means that these prospects are likely to change with new data releases, imparting a degree of volatility to financial markets and to global capital flows. The US policy rate trajectory is still expected to be moderate. The rand exchange rate has been affected by these global events, but has also been impacted by domestic fundamentals and political developments. Since the previous meeting of the MPC, the rand traded in a range of 14 rand 73 and 13 rand 28 against the US dollar, and has appreciated by 6.3% against the US dollar, by 4.3% against the euro, and by 5.2% on a trade-weighted basis. The rand initially appreciated markedly in line with other emerging market currencies as the chances of US Fed tightening receded in August following disappointing labor market data. At that stage, the rand recorded its strongest level since October 2015. This trend was reversed following increased domestic risk perceptions, which were also reflected in rising domestic government bond yields. More recently, the rand has been positively impacted by the stronger GDP growth outcome and a significant narrowing of the current account deficit following a sizable trade account surplus in the second quarter. Although this may reflect in part a delayed adjustment to the depreciated rand exchange rate, the trade surplus is not expected to be sustained at similar levels in the coming months. The marked appreciation of the rand during the past few days appears to be driven by expectations of unchanged US monetary policy, as well as to speculation regarding possible purchases of rand related to a major mergers and acquisition transaction. The rand, however, remains vulnerable to future changes in the US monetary policy stance, domestic political developments, as well as to a list of possible ratings downgrade later in the year. Nevertheless, the upside risk to inflation from the exchange rate appears to have moderated somewhat. The domestic economy remains weak despite the positive growth surprise in the second quarter of 2016, when an annualized growth rate of 3.3% was recorded. This was driven by a rebound in the primary sector and a surge in real exports. Mainly as a result of higher starting point, the bank's forecast for economic growth for 2016 has been revised up from 0% to 0.4%. The forecast for the next 2 years have been increased marginally by 0.1 percentage points to 1.2% and 1.6% respectively. Estimates of potential output growth are unchanged, implying a persistence of below potential growth. The trend in the bank's composite leading indicator of economic activity remains indicative of subdued growth. While the second quarter growth performance was more favorable, data for July suggests that this improvement is unlikely to be sustained in the third quarter. Both mining and manufacturing sectors recorded negative month-to-month growth rates in July, and the Barclays PMI declined sharply in August following 5 consecutive months above the neutral 50-point mark. Stresses are also evident in the construction sector, with a further sharp decline in building plans passed during July. A key constraint to the growth outlook remains the sluggish state of domestic gross fixed capital formation, which contributed negatively to GDP growth during the first 2 quarters of this year. In the second quarter of 2016, domestic fixed investment contracted in both the private and public sectors, including government and public corporations. Private sector fixed investment has recorded negative or zero growth for 6 consecutive quarters, reflecting low levels of business confidence. The RMB BER Business Confidence Index remains below the neutral level, despite an improvement in the third quarter. This adverse investment climate and rising costs have contributed to the further deterioration in employment prospects in the mining and manufacturing sectors in particular. The official unemployment rate increased to 26.6% in the second quarter from 25% a year earlier. The increase in employment that was recorded in the second quarter was almost entirely attributable to temporary employment opportunities related to municipal elections. Consumption expenditure by households remains weak, despite a return to positive growth following the first quarter of contraction. The annual growth of 1% suggests that consumers remain under pressure. Durable goods consumption continues to contract in the second quarter and is consistent with the further decline in the FNB BER Consumer Confidence Index. In July, retail trade sales declined further, in contrast to positive wholesale trade sales. Domestic new vehicle sales continued their negative trend in July and August, while exports of motor vehicles have remained robust. The outlook for consumption expenditure growth is expected to remain constrained, given the unfavorable employment outlook, the absence of significant positive wealth effects, and the slow pace of growth of real disposable income of households. Average wage growth and wage settlement rates have declined slightly, but there are risks of increases in excess of inflation and productivity gains. Credit extension to households continues to contract in real terms, likely driven by both the supply and demand side considerations. However, there has been a moderate increase in mortgage credit extension. As before, growth in credit extension to the corporate sector has been more resilient but below its recent peaks. Food prices remain a significant driver of inflation given the persistent drought, although long-range weather forecasts suggest improved rainfall prospects in the coming months. Food price inflation is still expected to reach a peak in the fourth quarter of this year at around 12.3%, slightly lower than in the previous forecast. Spot and future prices of wheat and maize have declined in recent weeks, but meat prices are expected to rise further as farmers restock their herds. Global food price inflation has increased mainly due to an acceleration in the price of sugar. International oil prices have fluctuated between $40 and $50 per barrel for the past 6 months amid uncertainty relating to a possible supply freeze by OPEC. The assumption for Brent crude oil in the bank's forecasting model is unchanged and assumes a moderate increase over the forecast period. After 2 consecutive months of price declines totaling R1.17 per litre, the domestic petrol price is expected to increase in October due to adverse movements in both the exchange rate and international product prices. The Monetary Policy Committee has noted improvements in the expected inflation trajectory during the course of the year. Apart from the tighter stance of monetary policy, this has also been driven by lower starting points as inflation surprised at times on the downside and changed assumptions underlying the forecast. The expected peak in headline inflation is notably lower, and an earlier return to within the target range is also expected. Most of the changes have been for the current and coming year, whereas the changes in the forecast for 2018 have been marginal. Changes to the core inflation forecast have been less pronounced, but it is no longer expected to reach the upper end of the target range. Despite these improvements, the longer-term inflation trajectory remains uncomfortably close to the upper end of the range, with high wage settlement rates and inflation expectations contributing to this persistence. The MPC assesses the risks to the inflation forecast to be more or less balanced at this stage. The current level of the range is stronger than that implicit in the forecast, and in conjunction with continued low levels of pass-through from the range to inflation, the risks are assessed to have moderated somewhat. However, some of the positive factors impacting on the rand may be temporary, and the rand remains vulnerable to both domestic and external shocks. The other major risk to the inflation outlook relates to food prices. The forecast still expects food prices to peak in the final quarter of this year. The future trajectory of these prices will be highly dependent on the normalization of rainfall in the coming months. Favorable weather patterns could see food price inflation falling faster than that implicit in the forecast. Despite the improved growth performance in the second quarter, the growth outlook remains constrained as reflected in the more or less unchanged outlook for the next 2 years. The MPC assesses the risks to the growth forecast to be broadly balanced, and growth prospects remain dependent on global conditions, implementation of structural reforms, as well as changes in business and consumer confidence. Given improvements in the inflation forecast and the weak domestic economic outlook, and the assessment of the balance of risks, the MPC has unanimously decided to keep the repurchase rate at 7% per annum. The MPC remains concerned about the overall inflation trajectory which remains in the upper end of the inflation target range. The MPC is of the view that should current forecasts transpire, we may be close to the end of the tightening cycle. The committee is aware that a number of the favorable factors that have contributed to the improved outlook can change very quickly, resulting in a reassessment of this view. The bar for monetary accommodation, by contrast, remains high, as the MPC would need to see a more significant and sustained decline of the inflation trajectory to within the inflation target range. We have reached that time now